US President Donald Trump says he plans to introduce 25% tariffs on all steel and aluminium entering the United States.
And when you look at just to what extent the US is dependent on other countries around the world, the higher this line is, the more dependent America is on imports. That is now well above, or it's been above 50%, it's kind of nearly 50% at the moment. It's around that point, which is down from kind of really low levels previously.
That it was already causing damage to the steel industry here in Hamilton. Orders were already starting to dry up. We're going to see layoffs. We're going to see some companies that are going to be really looking hard at whether or not they're going to be able to continue.
The American economy is a vast, interconnected machine, and in July 2025, a single decision sent shockwaves through its gears. The White House announced a dramatic escalation of tariffs on imported steel and aluminum, doubling them from 25% to 50%. President Donald Trump framed the move as a bold defense of American industry, a shield to protect the nation's manufacturing heartland from the perils of foreign dependence. It was a promise rooted in the rhetoric of resurgence, a call to bring back the glory days of American steel and aluminum, to restore jobs, and to fortify the industrial backbone of places like Hamilton, Ohio, and Pittsburgh, Pennsylvania. But beneath the patriotic fervor, a colder reality was already taking shape. The policy, meant to safeguard American jobs, was instead accelerating their destruction, unraveling supply chains, and handing a quiet victory to a neighbor that didn't shout back. Canada, with its steady hand and strategic foresight, wasn't just weathering the storm, it was thriving in it. As the U.S. doubled down on protectionism, the question loomed: why was a policy meant to revive American industry collapsing it faster than ever? To understand this moment, we must first step back to 2018, when the Trump administration first shocked global markets with a 10% tariff on aluminum and a 25% on steel, citing national security under Section 232 of the Trade Expansion Act. The move was heralded as a long-overdue correction to decades of outsourcing, a lifeline to industries battered by globalization. Factories in the Rust Belt cheered, union leaders rallied, and the White House painted a vivid picture of a manufacturing renaissance. Steel mills would hum again, smelters would fire up, and blue-collar communities would reclaim their pride. But the reality was far less triumphant. The tariffs didn't spark a boom, they triggered a slow bleed. Downstream industries, from automakers to construction firms, faced soaring raw material costs. Small and mid-sized companies, already operating on thin margins, began cutting jobs, delaying investments, or relocating operations abroad. By 2019, the Peterson Institute for International Economics estimated that for every job saved in steel and aluminum, 16 others vanished in industries reliant on those materials. The math was brutal, and the promise of revival began to fray. Fast forward to 2025 and the stakes are even higher. The decision to double tariffs to 50% wasn't a course correction, it was an escalation, a doubling down on a strategy that had already shown its flaws. Market analysts were stunned, business leaders blindsided. The Boston Consulting Group projected a staggering $50 billion increase in annual import tax burdens, nearly double the impact of the 2018 tariffs. Within weeks, the ripple effects were undeniable. Over 100,000 jobs were at risk, particularly in the Midwest and Rust Belt, regions already scarred by the earlier fallout. Foundries closed, auto plants scaled back, and machinery lines ground to a halt. The policy, sold as a shield for American workers, was instead becoming a wrecking ball. The failure of this approach lies not in its intent, but in its execution, and in a fundamental misreading of the aluminum industry itself. Aluminum isn't a product you can simply reshore with slogans or tax breaks. It's a foundational material, woven into everything from electric vehicles and aircraft to food packaging and skyscrapers. But producing it is a beast of a process, devouring electricity at a rate few industries can match. Smelters require immense uninterrupted power, often running 24/7 to stay viable. In this game, the United States is at a structural disadvantage. Electricity prices in industrial states like Ohio, Indiana, and Kentucky have climbed steadily, with some regions paying over 10 cents per kilowatt hour. Compare that to Canada, where provinces like Quebec and British Columbia have harnessed abundant renewable hydropower to create one of the world's most cost-efficient aluminum ecosystems. In Quebec, smelters operate on power costing as little as 4.5 cents per kilowatt hour, less than half the U.S. rate. In an industry where energy accounts for up to 40% of production costs, That gap isn't just significant, it's existential. This energy divide is the unspoken heart of the tariff's failure. No tax on imports can lower U.S. power bills or restart idled smelters. Companies like Alcoa have been blunt. Restarting a cold smelter requires more than policy signals. It demands long-term energy security, predictable pricing, and investment certainty. None of those exist in the current U.S. landscape. Grid prices remain volatile, regulatory shifts unpredictable. While Washington promises revival, the private sector runs the numbers and reaches a colder conclusion. The math doesn't work. Manufacturers are trimming shifts, pausing expansions, and in some cases, shifting capital overseas. In Michigan, Pennsylvania, and Indiana, states that once pinned their hopes on a manufacturing rebound, businesses are rerouting supply contracts to Canada or Europe. What was meant to be a domestic renaissance is instead becoming a slow retreat. The electric vehicle industry, a cornerstone of America's push toward a greener future, is feeling the shock most acutely. EVs rely heavily on aluminum to offset the weight of battery packs, requiring 2 to 3 times more of the metal than traditional gas-powered cars. When tariffs doubled in July 2025, the impact was immediate. Major players like Tesla, Ford, and Rivian faced sharp spikes in input costs, squeezing margins and delaying model rollouts. Smaller startups already stretched thin were hit even harder. Several canceled compact or entry-level EV lines unable to absorb the price volatility. Some began sourcing aluminum from Canada or Europe, bypassing the U.S. market entirely to maintain cost efficiency. Others scaled back production targets or shelved new vehicle launches altogether. What was once heralded as an American-led EV revolution is now tangled in a pricing war, with tariffs pulling in one direction and global supply chains in another. As Canada positions itself as a stable, low-emission supplier, the U.S. risks losing not just cost competitiveness, but leadership in the most strategic automotive sector of the next decade. The numbers tell a stark story. Within weeks of the 50% tariff, U.S. manufacturing reported a wave of job losses across aluminum-intensive industries. Trade associations and state labor departments projected over 100,000 jobs lost or at risk by mid-2025, many in regions still recovering from the 2018 tariffs. Factory utilization rates dropped, capital investment froze, and supplier networks fragmented. Meanwhile, Canada's aluminum output surged by 12% in the first quarter of 2025, fueled by cheap hydropower, modernized smelters, and stable export channels to Europe and Asia. Canadian producers didn't just fill the gaps left by the U.S., they accelerated, securing forward contracts with global buyers and positioning themselves as a hub for clean industrial materials. While the U.S. tried to wall itself off with tariffs, Canada expanded its global footprint, redefining not just where aluminum is produced, but who sets the rules for the future of industrial trade. The political fallout is as significant as the economic one. In 2018, labor unions rallied behind tariffs, hoping they would restore dignity to American manufacturing. By 2025, that support was unraveling. As layoffs mounted and production stalled, union leaders who once stood with policymakers began issuing public dissent. In battleground states like Michigan, Ohio, Pennsylvania, and Wisconsin, governors pressured Washington for tariff exemptions, warning of accelerating job losses. Some proposed carve-outs tied to clean energy or domestic sourcing. Others floated emergency relief packages. But relief was slow, and by the 2026 primary season, the blowback was unmistakable. Candidates from both parties, especially in swing states, began questioning the logic of tariff escalation. One prominent contender called it a self-inflicted wound disguised as patriotism, while others demanded audits of trade policy impacts. The narrative had shifted. What began as a bipartisan call to protect workers was now fueling a bitter reckoning in the factory towns that once believed in the policy's promise. While the U.S. braced for a counterpunch, Canada chose a different path. There were no angry press conferences, no retaliatory tariffs, no threats of WTO filings. Instead, Ottawa activated a playbook years in the making. It ramped up smelting capacity, streamlined transport routes, and unlocked export channels tested during previous trade tensions. Canadian trade envoys quietly expanded dialogues with Brussels, Seoul, and Jakarta, securing multi-year contracts with European automakers, Taiwanese battery manufacturers, and Indian aerospace suppliers. Canada's Export Development Corporation offered risk guarantees and flexible credit terms, incentivizing foreign buyers to switch from U.S. suppliers. This wasn't just market adaptation, it was strategic discipline. Canada didn't take the bait of a trade war, it played the long game, making itself so reliable, so integrated, that global buyers couldn't afford to ignore it. The supply chain began to bend, then break, around U.S. aluminum. Major corporations from automakers to aerospace giants had little choice but to adapt. With domestic input costs rising and tariff uncertainty clouding every cycle, many rerouted sourcing strategies to Canada. Exports of Canadian aluminum to the EU surged in early 2025. Japanese firms, traditionally balancing US and Australian suppliers, consolidated shipments through Vancouver and Saguenay. Even some US-based firms began importing Canadian aluminum, eating the tariff cost to stabilize operations. In a single quarter, Canada transformed from a secondary partner to a primary provider, not through confrontation, but by offering what global markets craved: consistency. Beneath this shift, Canada is engineering something even more ambitious: a new industrial ecosystem built around low-emission aluminum. At its core is ELYSIS, a revolutionary smelting technology developed through a joint venture backed by Quebec, British Columbia, and industry leaders. Unlike traditional methods, which emit large volumes of carbon dioxide, ELYSIS uses an inert anode process that produces oxygen instead, marking a potential game-changer for the industry. As Europe tightens carbon import standards and Asia pivots toward ESG-compliant sourcing, Canada is positioning itself as the only G7 nation capable of scaling industrial-grade aluminum without violating climate goals. In early 2025, Ottawa signed Memoranda of Understanding with EU governments, formalizing trade routes for green aluminum and locking in long-term demand. While the U.S. chases tariff battles, Canada is investing in the future of aluminum itself, aiming to become the world's top source of clean, stable, and geopolitically neutral aluminum by 2030. The tariff's impact extends beyond factories, reshaping the geography of trade. As aluminum imports became costlier, U.S. ports like Baltimore and Houston saw declines in metal traffic. Container volumes dropped, warehouse occupancy plummeted, and stevedoring labor was scaled back. Freight forwarders struggled with eastbound shipments, and ocean carriers trimmed U.S. docking schedules, rerouting vessels to Canadian deepwater ports. Meanwhile, Saguenay and Vancouver absorbed the growth, bolstered by years of investment in customs automation and electrified cranes. American companies began rerouting through Canadian ports like Halifax, adding costs at every mile. Third-party logistics providers reported a 20 to 25% increase in shipment costs due to longer routes, customs delays, and port switching fees. What began as a policy to level the playing field has fractured the map, embedding friction into every layer of the U.S. supply chain. This isn't the first time protectionism has backfired. In 2002, President George W. Bush imposed steel tariffs to shield domestic producers. The result, for every job saved, 8 others were lost in downstream sectors. The World Trade Organization ruled against the measure, and it was withdrawn within 21 months. The playbook in 2025 feels eerily familiar. Bold declarations, tariff hikes, promises of revival, and then the fallout. Factories lay off workers, logistics chains reroute, and domestic suppliers freeze in uncertainty. Meanwhile, Canada absorbs the momentum, not with fiery rhetoric but with quiet strategy. As U.S. aluminum grows costlier, Canadian exports surge. As Washington debates slogans, Ottawa invests in the long game. The real question isn't who imposed the tariff but whether this path is still worth following. Protectionism may shield the policy, but it exposes the economy. The numbers are clear. American jobs are bleeding, supply chains are fracturing, and global leadership is slipping. Canada, with its disciplined approach and clean energy advantage, isn't just winning, it's redefining the future of industrial trade. In the silence that follows Washington's thunder, a new reality emerges. The partner that stays calm may quietly become the one everyone depends on.